The inheritance tax changes announced at the last budget are set to take effect in April 2026. There are big changes to business property relief, or BPR, that will impact you if you own a trading business. Do nothing, and your children could be looking at a significant IHT bill. Now, the good news is that we still have some time to plan before the rules change. So in this video, I'll walk you through exactly what BPR is, how it works, and what's changing from April 2026, and what actions you should be taking before then. And as always, I'll share a few examples so that you can see the numbers and understand what the impact really looks like. If you're new here, I'm Abbas, a chartered accountant and chartered tax advisor at Saymur. I trained at a Big Four firm in their private client team, and I now advise business owners and families on inheritance tax, company structuring, and long-term wealth planning. So let's get into it. What is business property relief and why it matters? Well, BPR is one of the key inheritance tax reliefs that is available to business owners. It allows qualifying business assets to be passed on free of inheritance tax either during your lifetime or on death. The logic is simple. You shouldn't have to sell or break up a business just to pay up the 40% inheritance tax bill. Under the current rules, if you hold qualifying business assets like shares in a trading company for at least 2 years, then you can claim up to 100% relief on the value of those shares. In other words, they fall outside of your estate for inheritance tax purposes. That's why BPR is such a big deal for owner-managed businesses. For example, if your trading company is worth £2 million, BPR can save you up to £800,000 in inheritance tax. But from April 2026, that's all going to change. In autumn 2024 budget, the Chancellor announced major reforms to both agricultural property relief and business property relief. Now from April 2026, the default rate of relief is going to be cut from 100% to 50%, and with a new £1 million full relief allowance per person. So what does that mean in practice? Well, the first £1 million of qualifying business property will still get 100% relief, and then anything above that will only get 50% relief, so effectively a 20% inheritance tax rate instead of 40%. The £1 million allowance refreshes every 7 years, similar to the nil rate band, and it's not transferable between spouses. Each person has their own limit. And for trusts, the allowance is shared across all trusts settled by the same person. There's also a separate charge for AIM-listed shares, and these will only ever qualify for 50% relief, regardless of their value. So overall, this is a major tightening of the rules that have been largely unchanged for decades. So if you're planning to make gifts into trust, the timing is crucial. Transfers made before April 2026 will still benefit from the current unlimited 100% relief, as long as the conditions are met and you survive the required period. So actions to take. Before April 2026, if your business or estate is likely to exceed £1 million in qualifying value, now is the time to act. Practical steps include reviewing your asset base. Identify what qualifies for BPR and what doesn't. Trading versus investment activities, surplus cash, property holding companies, and so on. Consider lifetime transfers or trusts. If you transfer business assets into trust before April 2026, you could lock in the current 100% relief, even if the total value exceeds £1 million. Review your wills and succession planning. Because the allowance isn't transferable, married couples may need to rethink how assets are left between spouses. Revisit your company structure. Companies with mixed activities or investment subsidiaries may not fully qualify for relief. Tidying this up now could preserve eligibility. So let's take a look at a simple example. Let's say you own a trading company worth £2 million. Under today's rules, 100% BPR applies, so the full £2 million passes free of inheritance tax. Now, under the new rules from April 2026, the first £1 million gets 100% relief. The remaining £1 million gets 50% relief, meaning £500,000 is exposed to IHT at 40%. That's a £200,000 tax bill that simply wouldn't exist under today's rules. Now imagine that value is £5 million. The difference becomes even bigger, a potential £800,000 increase in IHT exposure. And that's why these next few months are a real planning window for business owners. One of the key opportunities before April 2026 is using trusts. If you transfer qualifying business assets into a trust now, those assets can still benefit from the current unlimited 100% relief, even if the value exceeds £1 million. That means no entry charge now, which is a huge benefit. After 2026, those same transfers would only get partial relief, and the trust allowance would be capped at £1 million only. Of course, this needs to be structured properly, with legal advice, valuations, and clear documentation. But for the right family businesses, it's a big opportunity to ring-fence value outside of the estate before the rules tighten. Now, before anyone rushes into setting up trusts or gifting shares, there are a few points to keep in mind. HMRC will expect robust valuations of business assets or shares when calculating relief. You can't just estimate what the business is worth and call it that. Mixed trading and investment companies can limit relief. If If your company owns investment property, for example, that might dilute the qualification and maybe the whole business doesn't qualify. Once assets are in trust, future flexibility is limited. Make sure it aligns with your long-term goals. And this is one of those areas where coordinated advice, tax, legal, and valuations really matters. The cost of getting it wrong can easily outweigh any short-term savings. So finally, business property relief has been one of the cornerstones of inheritance tax planning for decades. But from 6th of April 2026, it's going to look very different. For many business owners, this will mean a high inheritance tax bill if no action is taken. For others, it's an opportunity, a short window to use the current rules while they still exist. So if you own a trading business, or you're planning to pass on shares to family or into trust, it's worth getting advice sooner rather than later. The key takeaway here is timing. Planning done before April 2026 could literally save you hundreds of £1,000s in future inheritance tax. So if you found this helpful, give it a like and subscribe for more grounded, practical tax planning insights. And if you'd like to review your own position or structure before the changes, feel free to reach out and we're always happy to help. See you in the next video.